You know you want to buy a house, but you're not quite ready to take a full loan application with a mortgage lender yet. So what do? I'm a mortgage lender, and I'm going to tell you the steps that I recommend that you take, stuff that we look at as mortgage lenders to help put you in the best possible position so that when you do finally talk to that mortgage lender and take a loan application, there'll be no surprises and you'll be ready and know what to do. And maybe even know what the guy's talking about, because half this stuff is kind of nuts sometimes. We're going to break it down very simply. So if you've never bought a house before, most people get auto loans, right? You can go to a dealership or go to a bank and they'll say, okay, here's this loan for this much money and here's how much it is monthly. You're approved, right? And they, get a couple bank statements and they're done. The mortgage process is a little bit different. It is a financial colonoscopy. We look at everything. We're looking at every tiny detail on that bank statement. If you're applying jointly and you're newlyweds and you've got, those OnlyFans accounts or those credit cards hiding somewhere, we're going to know about all that stuff. So there's kind of three main components of the mortgage application. Here's what we want to see. So the first one is credit, right? Your credit score as well as your credit history. I can do mortgage loans down to a 520 credit score. Not a very good score. It's not going to get you the very good options. Gold is kind of 600, 620. That's when more options open up. Better options in the 720 plus. For the ballers, 800 plus. You've got your choice of any type of loan out there if you're 800 plus. The score itself, you definitely want to check it. If you haven't checked it, you can do it for free at www.annualcreditreport.com. Get your full credit report for free. It'll tell you everything that's showing up in there. That way you can view it before you talk to a loan officer, know exactly where your score is, what debts are, maybe if there's any collections or anything weird hanging out in there, and we can have a chance to fix those things. Number two is the affordability. You may have heard debt to income ratio or DTI. These are terms that mortgage lenders love to use. Maybe you've been declined for a loan before because they said your debt to income ratio was too high. So what is a debt to income ratio? It's your debts and your income divided over each other. That gives us a percentage. Based on what that percentage is, depends on how much of a loan we can give you. Here's a quick, easy one. This one is kind of what I use to give you an idea of what you might qualify for a mortgage payment. So what you're going to do first is to get your total gross monthly income. So for W-2 people, if you get a W-2, you make 20 bucks an hour. That's pretty easy to calculate. 20 times 40 times 52, $41,600 a year. So monthly, that's $34.66. So I'm going to use round numbers for the example purposes. So here's the quick little breakdown. So let's say it's you and your spouse. Together you make $8,000. So we have a gross monthly income of $8,000. Your wife has a $1,000 car payment and you've got about $1,000 worth of credit card bills. So we have $2,000 in debt. What we're going to do is we're going to subtract that $2,000 from the $8,000 to give us $6,000. We're going to take that number and times it by 0.45. 45% is what we're looking for because typically your mortgage payment can't be higher than 45% of your total income. 8,000 minus 2,000 times by 0.45, that gives us $2,700. They can comfortably afford $2,700. Again, not officially, this is just the pre-work before we take the application. That gives you a good baseline, right? $2,700 per month is what they could potentially qualify for in a mortgage. So what does that equal in a price point? Well, this is when the third item comes into play. The LTV, the loan to value, all these freaking acronyms that we use in mortgage. That just means how much money you're putting down. How much money are we financing compared to the value or the sales price of the property? VA and USDA, 0. You can finance up to 100% of the property. With an FHA loan, you can finance up to 96.5% or all but 3.5%, meaning you need 3.5% down. And conventional, if you're a first-time home buyer, you just need 3% down payment. If it's not your first time buying a home and you're still using a conventional loan, the minimum down becomes 5%. $2,700 a month for this couple, depending on the down payment, this would allow them to qualify for anything between $350,000 and $400,000, depending, based on where rates are and assuming a very minimum down payment. Bigger down payment means the more you can afford monthly. So again, it's like a big puzzle, right? We're putting together all these options. The biggest numbers that you want to know, because I feel like still, people when I have these loan consultations, they still don't even know what these numbers are. They don't know what questions to ask. So the ones you want to ask yourself first is, what am I comfortable with spending monthly? And so a good place to start is, how much are you paying in rent? Is it tight? Is it expensive? Could you probably afford a little more, but would love to pay less? I mean, we all would love to pay less. Figure out what that monthly budget looks like and what your total maximum amount is. A weird one I've been getting lately is I've been getting a lot of people that are renting apartments, and then they call me wanting to buy a house and assuming that their mortgage payment is going to be cheaper than renting an apartment. Probably not. just think about that mathematically and realistically, right? If you're renting a little, 1 bedroom, 2 bedroom, and now all of a sudden you want to buy a 3-4 bedroom house, why would you think that would be cheaper than renting an apartment? It might be comparable. It might be very close to what you're paying, but the chances of it being significantly cheaper is just low. I don't know. I think some people are just a little unrealistic with that stuff, especially if you're going from an apartment to a house. The payment's going to be comparable, but it's probably going to be higher than what you're paying in rent. I'm not 100%. I've seen many situations where it can be cheaper depending on what you buy and the total sales price. But again, something to keep in mind. The second piece of that is, so, once you figured out kind of where your budget is monthly, and you want to figure out the max, right? So if it's if you can handle $3,000 a month, but definitely no more than $3,500, set that budget for $3,500, and then when we do take the loan application, I'll show you a few different sets of numbers. I'll say, here's what you qualify for, and then here's what $3,000 a month equals, or $3,500 a month equals, or whatever, right? And then usually we can find a happy middle ground based on the price that you want for the houses that you're seeing and the comfortable monthly payment. And then we get you that pre-qualification and you go and find the house. The third part of this, or the total of it is your total out of pocket, your assets. How much money do you have? The down payment, the closing costs, paying for the appraisal, the credit report, the home inspection, all of these little extra costs that might be involved. How much money do you have total saved up? And this is one of my favorite questions to ask, and it's still weird to me that so many people don't know how to answer it. But ultimately, it's how much extra available money do you have to spend? Do you have an extra $5,000 that you can use for that? Do you have 10, 20, 30? Set that aside and know that that's what you have to work with. And if you tell me that that is all the money you have to work with, and this is what your monthly payment is, I will find an option for you. And if I can't, I will tell you why. I will tell you the missing piece. You either have too much debt, credit's not good enough, whatever it is, and then we give you a plan so that we can correct that item and make it work so that we can get you into a home. There's all this negative news going on saying that home ownership is unaffordable, that millennials can't buy homes, that Gen Zers can't buy homes. Guys, you can. You absolutely can. I'm living proof of it. I bought my very first house when I was 23 years old. I understand the market was a little bit different, but even in today's market, it is doable. Even with minimum wage, trust me, the numbers do not lie. There are properties out there, there are homes for sale. They're not gonna be like this one. You're not gonna get $1 million house, a $2 million house. You will get something to live in, which will allow you to start to earn equity and appreciation. And as the years go by, and hopefully as rates get lower, we can refinance, open up a better budget for you, make more money, spend less on that mortgage, have your property earn additional value. Then you can leverage some of that equity, buy another property, a rental property, which will make you money. Again, you've got so many fun options when it comes to home ownership, and this is why I get so excited about it. So if you want to get started, but you're not quite ready to take a loan application, start working on these 3 things. Check your credit, find out what that monthly budget is, and find out how much total money you can spend out of pocket. Once you have those items and you realize that you are in a spot where you can do that, that's when you want to call me or a mortgage lender and get the process started for a full loan application. That way we can do that good old financial colonoscopy, get you that pre-qualification and get you searching to buy your very first house, and then you can take advantage of all the cool things that comes along with it. So let's get started today. Hit me up on my website really fast. If you don't want to talk to me, you can send me a text. You can send an inquiry on my website and request a 10 to 15 minute conversation and talk about your goals and concerns. I'm licensed in Arizona, California, Texas, New Mexico, Colorado, and Virginia. So if any one of those states you need some help in financing, give me a call. I'd love to be your guy.